Good afternoon, everyone. Firstly, welcome and thank you for joining us for this webinar session presented by 274 Investment Managers. Now, in today's session, we'll be discussing everything two-pot and how sort of the retirement fund industry will be changing come the 1st of September this year. Now, we're only roughly about 5 weeks away from the implementation of this new two-pot system. So I think it's very, very important that every retirement fund member or even potential retirement fund member become aware of what the new system is about so they can get to grips of how things will be done moving forward. Now, what we hope to achieve out of the session today is to provide some context in terms of, firstly, why the change, right? Why is there a change in the legislation? And then secondly, what exactly is changing in the legislation and how would that impact retirement fund members going forward? Now, during the session, of course, I'm sure there'll be questions. And if you do have any questions, and I'm expecting quite a few because the two-pot has been sort of in the media of late. If you do have any questions, please type them in the chat function and we'll get to them at the end. I think we'll leave about 10 minutes at the end for question time. Now, of course, I'm not alone. I'm joined by a colleague of mine, Reinier Joubert. Now, Reinier is a senior consultant within our advisory division at 274, and he's got sort of extensive experience in employee benefits. So, Reinier, thank you very much for joining.
Thank you, Masood.
Okay, let's jump straight into it, right? So I think, firstly, let me start off by saying that at 274, right, we would support any initiative by government that is sort of intended to lead to better retirement outcomes for our retirement fund members, right? And sort of foster a savings culture or improve the savings culture in South Africa. Now, if I cast my mind back probably 12 months ago, right, same time last year, there was the proposed changes to the draft revenue laws amendment bill, and those changes were largely aimed at addressing two main concerns that National Treasury had at the time. The first thing that I picked up was sort of inability to access retirement funds in the case of emergency, right? And this was really heightened or highlighted during the COVID-19 pandemic we had a few years ago, where, you know, households were in dire financial distress. I mean, many people lost their jobs and households were, as I said, in dire financial circumstances. And typically these were members where, you know, most of the assets were tied up into retirement funds and they couldn't access it, right? Again, typically these are members where the short-term requirements far outweighed their long-term retirement goals, right? And they just couldn't access the retirement funds. That was the first thing. The second thing was that, you know, a lack of preservation, National Treasury, there was a concern around a lack of preservation and just general retirement considerations. More specifically, to avoid a case where members were simply accessing the retirement funds so they can access some of it in cash. And they need you know that when members access a portion of the retirement funds in cash, right, invariably that leads to a shortfall at retirement, right? So those were the two key things that I picked up 12 months ago when these proposed changes were suggested, was the main reasons why they wanted to implement this new system. Now, this past Sunday, we saw that our president, President Cyril Ramaphosa, signed the Pension Funds Amendment Bill into law, right, which effectively enabled the implementation of this long-awaited retirement reforms. Now, even though the two-pot system, it's being referred to this new legislation as a two-pot system, what I think is very important for members to understand is that these new changes won't be applied retrospectively. In other words, all contributions that you make up until the end of August and any growth associated with that contributions, the new legislation won't be applied to that. And I'm hoping, Reinier, you unpack a lot of that in a lot more detail. But why I'm mentioning this up front is that even though it's called the two-pot system, I think it's very helpful for members to think of the retirement benefits in three different components, right? So, Reinier, I think let's kick off our discussion. I sort of gave my input in terms of why, you know, the implementation of the new two-pot system, thinking 12 months back, right? We're now almost there, 5 weeks to go. So maybe let's start off and you share some thoughts around why you think the implementation of the new two-pot system is being introduced into our retirement paradigm.
Thanks, Masood, and thanks for everyone for joining us this afternoon. So now Masood eloquently summarized what this two-pot is all about and where it comes from. Now it's up to me to add to everything Masood has said and give you the technical nitty-gritties as we go along. So why was this implemented? And Masood is quite 100% correct there that when people leave their jobs, they take their monies in cash. In COVID, we had the issue where if you had lost your employment, what did you do? You needed retirement, or you needed funding to take you over a few months until you found something else, and you withdrew all of your retirement funds. This leads to members having pretty much nothing when they start their next job, starting all from scratch. And the older you get, the more difficult it is for you to have enough at retirement to maintain your lifestyle. So we know that there's a statistic that says about 10% of South Africans are able to keep the same lifestyle. I think 10% is very generous. I think it's more likely to err on 5% of South Africans can keep their same lifestyle once they get to retirement. It's a catch-22 as to how much you need at retirement to have a comfortable lifestyle. But more on that in another webinar when we unpack what a net replacement ratio is and how it's important that we plan for that when we help members and our clients. So bearing all of this in mind and knowing that we do not have enough tax to increase the SASSA grant for guys who are eligible for old age pension, the two-pot system was introduced. And this was to help members to actually have something available the day that they retire to provide that very important income when they need it most. But also, with this implementation, they've also made allowance that you can withdraw certain portions of your contributions made in the event of an emergency. And we know emergencies happen without the drop of a hat, and you do need access. And a lot of people in the past used to resign from their employment to cash in their retirement funds in the case of an emergency, and then maybe get re-employed at the same employer or not be employed at all. So that's pretty much why it's been implemented. And I think I'll just hand back to Masood to see if there's anything else that we would like to go and explore.
Yeah, so Renier, so we know the why, right? Now let's talk about the different components, right? So as I said, it's called a two-pot system, but effectively there's three different components, right? So talk to me about each of those components and how it's going to work going forward, starting the 1st of September.
Cool, so let's jump in. So on the screen, you'll see three little blocks, and that's the easy version of it. There's a savings component, a retirement component, and a vested component. The legislation is quite technical, so I'm going to try and delve into it as simple as I can. But what's important to note that if you were in a retirement annuity or a pension fund, you would have three components, and that would be the savings, the retirement, and the vested component. There is some anomalies, or there is some exclusions if you're in a provident fund. And that is very much pertaining to members who were over the age of 55 on the 1st of March 2021, when the harmonization of retirement funds came to effect. So when we delve into it a little bit deeper, what can you expect in your vested component, and how would things be split when we look at it on the 1st of September? So the total fund value in your fund at the 1st of September would be split into, and this is why I say in easy, it's three little components, but the vested component has got two components to it. And this is very much applicable to provident funds more than what it is to the pension fund, the splitting of the two portfolios. So if you were in a provident fund, pre-2021, you would have a vested amount when harmonization happened. From 2021 to 2024, 1st of September, you would have a non-vested amount. What do we mean with that? That means whatever you saved in your Provident Fund from 2021, March 2021 to September 2024 would have been used, and you would have had to use it and apply it the same at retirement, meaning 1/3 as a lump sum and 2/3 to purchase a pension. Important to note here is that there will be no new contributions into the vested component. There's one exception, which we'll deal with just now. All the rules applicable to the money in your vested component, so in your LA, in your RA, in your pension fund, and in your Provident Fund, all of those rules that you are comfortable with now still applies to this particular component of the system after the effect of Two-Pot. On resignation, on retrenchment and dismissal, all of this vested component is still available to a member. On death, this will go to the beneficiaries identified by the trustees of the fund. And on retirement, you will have a portion that can be taken in cash, and the rest must purchase a pension. Members over 55, and that's why I said there was an exclusion, members over 55 at the 1st of March, that means at the end of August, on the 1st of September, they would be 58.5 and thereabouts. They will continue contributing to the vested component, and all the rules that were applicable to them, i.e. the big thing, they could take the entire component as a lump sum at retirement, would then still be applicable. So just a recap, there's going to be a savings component, and how are we going to contribute to this in the future? So savings component, important to note, you don't need to leave employment to access this benefit. There's a maximum withdrawal of 1 time a year between March and Feb. So that correlates or coincides with the tax years. If there's less than 2,000 Rand in your savings, then you cannot withdraw the value. Any payment from the savings component will be taxed as income, and there will be a fee charged to facilitate the payment. With the retirement component, which comprises of 2/3 of your contributions in the future, your retirement component will not be accessible before you retire. If you leave employment, you either have to preserve internally with the fund you are in, or move it to a preservation fund, or move it to a new employer. If you retire, this money in the retirement component must be used to purchase an annuity. Members over 55, they will not have a savings component or a retirement component unless they opt in to the Two-Pot system. So I don't know if there was any questions, but some of the questions that we've been regularly asked is, and what members ask us is, can we claim 1/3 of our benefit? So I guess you can see on the screen that, yes, there is a reference to 1/3, but that's the contribution that goes into the savings component. It's not the amount that they'll be getting once this comes into effect.
Okay, so very importantly, and I see you highlighted it in blue. So if members of 55 or over as at the 1st of March 2021, the Two-Pot system wouldn't exactly apply to them unless they decide to opt in. Am I correct?
Yes. Yeah.
Okay. Now, talk to me about accessibility, Rainier. Accessibility in terms of, so we've heard that there will be a special allowance made within to sort of fund the savings pot for the first withdrawal, right? So I'm assuming this is what they refer to as seed funding, right? So talk to me about the seed funding, but also practically speaking, Rainier, what should members expect come the 1st of September, right? So the one thing is you've got accessibility and this seed funding, which you'll talk to, but then also from an administrative point of view, from a SARS perspective, you know, there's a lot of moving parts here. So one, deal with the seed funding, but then also practically speaking, if for argument's sake, a member does submit a withdrawal, in September, what can they expect from administrative point of view?
Okay. So seed funding is a nice little bonus payment, if we can call it that, or that's an explanation of 10% of your vested component. And it is capped at 30,000 Rand. So this is a one-time only start or booster to your savings component. It will be taxed pretty much at your rate that you pay tax on your salary. Reason for this is that when you make contributions to a retirement fund, you can deduct them from your tax liability. So therefore, when it comes to withdrawal from your savings pot, it's then seen as income, and therefore the marginal tax rate is applied. So from a SARS point of view, and we've had a lot of different opinions and a different sort of answers from administrators on the process when you do the savings withdrawal, is that when they apply for the tax directive that they have to when they do your withdrawal, they need to confirm the salary that you earn so that they can apply for the right marginal tax rate to be used in the calculation. Most administrators will be charging a fee to do this. And the reason for this is that there was a lot of development in our systems in the retirement fund industry for something that we've never ever done before. Giving members directly access to their retirement funds, not via the employer, only on two instances, either exiting from the employer or retiring from the employer. We've got quite a few things around when seed funding will happen. So the weekend when this comes into effect, the Saturday is August, the Sunday is September, and majority of the administrators will be working through the night, through the weekend to apply the seed funding. It is important to note that with the legislation for the pension funds amendments being signed into effect only this last Sunday, and we've got 5 weeks to go before implementation, the Financial Sector Conduct Authority could not approve rule amendments, or must now only start approving rule amendments to allow administrators to actually do savings pot withdrawals and apply the new legislation from 1st of September. So there might be slight delays in some of the administrators where they are waiting for the rule amendments to make the changes to allow for this legislation to come into effect. From our side at 27.4, we would like to just highlight that err on the side of caution, wait for the August contribution to be invested before the monies can be claimed. And also, we expect that payments may likely not be made before the end of October, just due to that there is a lot of moving parts that needs to be put in place for withdrawals to happen. Again, in the blue block, and it's going to sound like a broken record by the end of today, but members in Provident Funds and Provident Preservation Funds who are older than 55 on the 1st of March 2021 will not have a savings component. Thus, there will be no seed funding available for them to withdraw unless they opt in to the two-pot system. And I think the other question that is probably top of mind of all of the audience in the webinar today is, what happens if I've got a company fund, I've got a retirement annuity, I've got a preservation fund? Some people have more than one retirement annuity depending on their strategy at retirement. Am I only allowed to make one withdrawal? And the answer is no. The legislation is applied to product level. So if you've got a company fund and you manage to have enough in there to get 30,000 Rand, you can make a 30,000 Rand withdrawal from your company fund. Same applies to your retirement annuity, to your preservation fund, and the like. So there would be the allowance to make this seed funding withdrawal, the first withdrawal, getting seed funding, per product that you have that's a retirement vehicle.
Okay.
Masood, I see there's some comments and questions. I don't know if we want to just double check those before we carry on.
Yeah, I think let's take some questions before. So the question comes in, what if a person is 58? Can you provide an example? So I think you covered that, but maybe just reinforce it again. 58 years old, the client's invested into a retirement fund. What happens?
Okay, so if you are 1st of September, if you are 58 years and older on the 1st of September, and you are a member of a provident fund, the action word here is provident fund. Pension fund members are not affected by the over 55 rule. It's only applicable to provident fund members. And it is because harmonization happened in 2021, and the treatment of your funds at retirement for provident and pension funds before harmonization were different. Right, so if you're 58 in a provident fund, you will be excluded from the two-pot system unless you opt in.
Okay. Now, Renée, talk to me about, let's discuss a few scenarios that's likely to impact a member's working life, right? So we discussed the different components. So you've got the vested component, or let's call it the legacy stuff, right? You've got the savings pot and you've got a retirement pot. Now, let's, for argument's sake, say a member resigns versus, you know, they dismissed or retrenched. How would these components work in those scenarios?
Okay, so I had some examples here for the seed funding. Let me just quickly tackle them, and then I'll carry on and then explain what happens when a member exits employment before retirement. So on the screen, we've got two examples. We've got Mohammed and we've got Nobuhle. So Mohammed is 35 years old. He's in a provident fund. On the 31st of August, he has a total of 100,000 Rand in his provident fund. That means 10% seed funding equals 10,000 Rand. And that would be transferred and be available in his savings pocket, meaning that 90,000 Rand remains in the vested component. And this is very important when we get to the examples and when we get to the discussion around exiting the fund. So Mohammed has a few options come the 1st of September. He can withdraw all or some of the value in cash, so the seed funding that's been transferred, and there will be a transaction fee and there will be tax. He can either then leave it in his savings component to grow and access it once a year if needed, if there's an emergency, or he can leave it in the savings component, not touch it, forget that he has access to it until the day that he retires, and that in effect would be his lump sum commutation amount. So that's Mohammed. That's a very forward-thinking, retirement-driven member, leaving the money in retirement fund for retirement. Nobuhle is 30 years old, and in July she left an employer and she took the 80,000 Rand that she had. She then started somewhere new, and on the 1st of September or on the 31st of August, she managed to save 10,000 Rand in her provident fund. Meaning if we apply the 10% rule for seed funding, she only has 1,000 Rand available, leaving 9,000 Rand in a vested component. Because we have the limitation on withdrawal on the savings pot being a minimum of 2,000 Rand, Nobuhle won't be able to withdraw anything on the 1st of September. But she will be able to draw it if we then assume that her fund has grown to 3,200 in January, that she can then make a withdrawal, pay the taxes and pay the fees. An important warning here, and I guess I'm preaching to the schooled and the scholared, but by withdrawing from the savings component, Nobuhle is impacting the amount that she would have available as a lump sum at retirement. So when we look at what happens when you exit your employer, so when you decide that you are going to work for somebody else, or you get retrenched, or you get dismissed, savings component treatment is if you've not made a withdrawal before in that tax year, you can take the full value in cash when you leave. If you have made a withdrawal during the tax year that you leave the employer, whatever is left will remain in the savings component and transfer to either a new employer retirement fund or a preservation fund. The retirement component, and I think this is going to be this is the best part of the two-part system, is the retirement component stays intact. None of this money can be paid in cash. It must be taken to your new fund or preserved. So the intention of the retirement component is quite clear. You can only access it at retirement. The vested component that you would have, that is available to withdraw in cash as current legislation allows. Then again, members over 55 on the 1st of March 2021, they will only have a vested component which they are able to take in full cash when they leave employment. If they choose to take part in the two-part system, what I've just explained in terms of how this would be handled in exit, savings, retirement, invested component, that then becomes applicable to them. So I've got an example or two. Maybe this will just give us a little bit more perspective. So now we've got Yusuf, who decides to leave his employer in Feb 2025. And that dude is very cool. He looks like someone from the Matrix. At the end of February 2025, he's got the following values in his Provident Fund. He's got a savings component of 15,000, a vested component of 95,000, and a retirement component of 20,000. When he leaves his employer, he can do one of the following. He can withdraw the total of his savings component and the vested component. Disclaimer, savings component will be taxed at marginal tax rate. Vested component will be taxed at the withdrawals tax table. That amount he will then get paid out, pay the taxes, pay the transaction fees. Or he could preserve the money, the savings component, and his vested component by either leaving it in the current fund or transferring it to a new employer or transferring it to a preservation fund. Doesn't matter what he does with his savings invested component when he leaves at the end of Feb. The amount that is in his retirement component will be, must be, and I don't know if there's another stronger word in English I can use to emphasize it, but it will and must be preserved or left in the current fund or transferred to his new employer or preservation fund. That money is not accessible. So when we look at the second example, we've got Mary, who leaves her employer in June 2025. In April 2025, Mary withdrew. Oh, sorry, that must have been savings. Oh, sorry. I'm reading in two screens and I should just be focusing on one. Apologies. So in April, she made a withdrawal from her savings component for an emergency. At the end of June, she has the following values: 3,000 in her savings, 10,000 in a vested component, and 30,000 in a retirement component. So when she leaves the employer, she's got the following. Because she's drawn money from a savings component in the current tax year, she can't make a further withdrawal from the savings component when she leaves. However, she can draw her vested component and pay the relevant taxes. And her retirement component, the same applies to her that applied to Yusuf. It will be preserved until she gets to retirement.
I think a very important point, and you did touch on it, Renier, is that members need to understand that any withdrawals made from your savings pot is taxed at your marginal income tax rate, which is quite punitive. And I think it's by design, because what the legislation is trying to implement is that only touch your savings pots in case of an emergency, right? Because there's a clear tax incentive for you to hold that money up until retirement, because there is a very different tax table that's used at retirement, and you've even got a portion that's tax-free when you withdraw at retirement. So there's a clear message from the legislation is that the savings pot is there and it's designed for you to have access only in times of emergency. Because of that additional taxes, you wouldn't want to access it other than in cases of emergency. And I think that's a very important point that members need to recognize. Yeah. So, okay. So we discussed resignation, we discussed dismissal and retrenchment. But now let's, for argument's sake, the employee, has a pretty smooth working life, now they're at retirement. Okay. So now talk to me, what happens at retirement in terms of the new two-pot? How would that work?
Cool. So at retirement, we're going to have the savings component. So in a perfect world, you would have saved up your 1/3 up until retirement, and you can take that value in cash. Now, important to note that when you withdraw the savings component, when you get to retirement, it's seen as retirement action, meaning the tables applicable to the retirement lump sums will be applied. So it's not marginal tax rate when you retire. It is the retirement fund lump sum tax tables from SARS, because you are ending your employment. The vested component, when you get to retirement, a portion of that value will be taken or be allowed to be taken in cash, with the rest being added to the retirement component to buy an annuity. And in the retirement component, obviously, you've got the money earmarked to buy that annuity, or commonly known as a pension, at that point. Very important, and I think the guys who are over 55 at the 1st of March 2021, who are now going to be 58 in a little bit on the 1st of September, who are in the same fund, opted not to be part of the two-pot system, so meaning they did not opt in, they can take the full value in cash when they retire. Any members who's chosen to opt in, savings component, vested component, and retirement component, how we apply those at retirement would be applicable to them. So I think I just want to touch on another point, is that members that are over 55, 1 March 2021, in either the Provident Fund or Provident Preservation Fund, they don't have to let the administrators know before the 1st of September whether they want to opt in to the two-pot system. They have 12 months to make an election. And the seeding, so we discussed the bonus start-off value in your savings component. For those members, so if, argument's sake, you're a member over 58 on the 1st of September, you decide in December that you want to form part of the two-pot system, effective 1 Jan. At the end of January, they'll then apply seed funding, and that will be then available for you to withdraw, if that is the intention. So it's just important that guys note that you've got 12 months to make the decision. And we encourage advisors to have discussions with their older clients who are nearing retirement, because 10 years to retirement is not a very long time, to have the discussions and discuss the pros and the cons of opting in versus not forming part of the two-pot system. So I've got 2 examples here as well, which might just help you understand a little bit better on how this would be applied. So we've got somebody who was under the age of 55 on the 1st of March 2021. So he's got the following values when he retires. He's got 45,000 in his savings component, 350 in his vested component, and 400 in his retirement component. So what happens when this member retires? He can withdraw the total of his savings component, subject to lump sum rates, because he's retired. He will be able to draw the portion of his vested component that would have been applicable of, so harmonization happened to him. So 1/3 of that would be withdrawable. at retirement, pay the relevant tax rates, and the balance of the vested and the retirement component together will then be used to purchase a pension. And this is a common example for guys who were in provident funds younger than 55 at 2021, but this is also very applicable to members in a retirement annuity and a pension fund, because this is how that would be enacted and what you can do at retirement if you were a member below 55. On the other side, we've got Sajida, who was in a provident fund. She was over 55 and she did not opt in to the two-pot system. She's got a value of 1.5 million rand. So for her, the world is an oyster. She can withdraw the entire vested component, pay the taxes. She can do either a portion and purchase a pension with the rest, or she can use the full value and buy a pension with that. So I think another important thing to highlight is, and I think it's something that's come up in a few of the other webinars and conversations I've had around two-pot in the last couple of days, and I already feel like I'm going to have two pots when I go to bed, is that there's a sort of maybe a miscommunication or misinformation around savings pot withdrawals and how that would affect the tax-free amount at retirement. So let me try and clarify that for you right now. So savings pot withdrawals are included in the definition of taxable income while you're still actively employed. Therefore, they do not accumulate to the 550 tax-free concession that's available at retirement. So unlike withdrawing your funds or resigning, using up to 27,500 Rand, that you need to then calculate that you've taken that amount before when you retire and subtract it from the 550. Your withdrawals from the savings pot doesn't affect the tax-free lump sum amount that you would be entitled to at retirement.
That's a very important point, right? So what you're saying is that even if I take from my savings pot, it wouldn't impact my tax-free allocation when I do retire, of 550,000. Yes. Okay, perfect. Yeah. Staying on this slide, Renier, so you've got the three components, right? For example, Simpiwe's got savings component, a vested component, and a retirement component. So at the moment, right, our retirement fund members, what they've seen on these statements is one value, right? We've just seen one value on the statement. So going forward, are administrators going to include three? How's the statement going to look for these members?
So the statements are going to become a little bit longer, because we've got three pots, but they are going to show you what is available in your savings component, what's available in the vested component, and in the vested component, should you have a vested and non-vested benefit, they would classify between the two, and then they would show you what the retirement component looks like. Also, the other thing that administrators will include on that is there would be a history on your benefit statement saying that you took money from your savings pot in the 2020, where we're going now for 2025 tax year, so that you know that you have taken one. It's part of their system, because they need to flag it somehow that you've already made a withdrawal from the savings component, as you're only allowed one withdrawal per tax year from that particular product.
Okay, perfect. Okay, so we spoke about resignation, dismissal, and retrenchment. Before we get into some of the questions that's come through, let's go full circle, right? So let's talk. So we're covering all our scenarios. So let's talk about what happens when a member passes away, right? So we know that with retirement funds, we have the ability to nominate beneficiaries on these retirement funds, which is fantastic because it creates sort of some kind of liquidity in the estate, right? But talk to me about how that process would work if a member were to pass away.
Okay, so in the event that this happens to a member, all three components will be lumped together. The value of these components will be distributed in line with the Pension Funds Act. So thus it's very important to complete the nomination of beneficiary form, because the trustees on your pension fund, on your provident fund, on your retirement annuity fund, on your pension or provident preservation fund, they have to conduct an investigation around financial dependency as guided by Section 37C of the Pension Funds Act. So it's very important that they know who's who in your environment, in your life, so that they can then go and do the investigation, distribute accordingly. So in a nutshell, everything that's in your retirement fund will be distributed based on the findings of the investigation conducted by the trustees and then paid out to them following the completion of that.
So it's very important that members understand that the beneficiary nomination form, although it's not going to ultimately decide, but it's going to be a good indication for the trustees to make the correct decision. Am I right?
Yeah. Yes. Yeah,
Okay,
as much
good.
as the trustees would like to know every single member on their funds, it's very, very unlikely that they would know who's who coming across their desk. That's the ultimate way for you to allow them to have a look into the life that you had before you passed away.
Okay. Let's tackle some of the questions that's come through. So we've got a bit of time, so we'll go through these in detail. So we covered the one, if you're over 58. Another question that's come through, Renier, what happens ultimately to the 1/3 vested portion? Does the value reduce as you draw an annuity? What happens to the remaining value upon death? So we covered a bit of each of that, so maybe just reinforce each of those questions. I'm going to repeat it. So what happens to the 1/3 vested portion? Right? And does the value reduce when you draw an annuity, and what happens to the remaining value upon death?
Okay, so I think I'm gonna recap that, because that's like a retirement sort of question there. So currently, and let's maybe do a before and after comparison. So currently, when you retire from a pension fund or retirement annuity, you have access to 1/3 of your benefit as a lump sum. You don't have to take it, but you can take it. With the remainder, you buy an annuity. The annuity would provide you income depending on how you've chosen to invest it, either living or life annuity. What you've done with the 1/3, and that would have to be reinvested to give you growth. Alternatively, if you've used it or you draw from it every month, that capital will diminish. So that's on a pension and a retirement annuity, how that works. For members over 55, 1 March 2021, being 58, 1 September 2024, when they retire, they have the option currently, and they will have the option post two-pot if they do not opt in, is that they can take the entire amount as a lump sum and invest it according to how they deem fit, or they can do 1/3, 2/3 split, or put everything away for a pension fund payment. Now comes two-pot, and we've got access to savings during the lifetime that we work. At retirement, if you were in the system before September 2024 and you were younger than 55, so now I'm talking about somebody who's on either a provident, a pension, or a retirement annuity. Before March 2021, you were under 55. So I'm going to talk to all of you at the same time. At retirement, you would have a savings component and you would have a retirement component. Savings component we have now established you can use during your lifetime to access it for emergencies. Alternatively, that is the lump sum amount that you'll have at retirement. Retirement component only accessible at retirement to purchase a pension. If you had a vested pot, all of the rules that we explained, so pension 1/3, 2/3, if you were in a provident fund before harmonization, you would have a certain portion that would be available as a lump sum withdrawal, and the remainder of what you contributed from March 2021 to September 2024 would then have to follow the rules, being 1/3 commutation, so lump sum amount, and 2/3 being used to purchase a pension. So everything remains the same. It just becomes slightly more complex. However, it's the same thing in essence. 1/3 will be available for you at retirement to take as a commuted lump sum, while 2/3 would then be used for pension. So I hope I answered it. I don't know if I quite answered the diminishing value bit of that question.
Yeah, so that's more related to after the commutation, sort of they're going to be drawing from an investment-linked living annuity or a guaranteed annuity and so on. Now, Renier, in terms of the savings pot, right? When it comes to paid up retirement annuities, like non-paying RAs, for example, will there be, the question is, will investors have a savings pot in those type of RAs that's paid up, that type of thing?
Yes. So in a, and I think I can use this terminology, in a new gen RA, and it's a paid up RA, there will be a savings component. Every single retirement product come 1st of September will have a savings component and a retirement component and a vested component. Only members who start contributing to retirement funds past 1 September will only have two funds or two components. Everybody else will have the 3 components as we discussed. There will be a savings one. It's a paid up investment, so that means you can't make further contributions into that one unless you opt to. For preservation funds, the same thing applies. There will be a savings component aided by the seed funding come the 1st of September, whenever that administrator is ready to put that in place for you.
So basically what you're saying is, with non-paying RAs, or like, for example, preservation funds where you can't contribute to that retirement fund on an ad hoc basis, you're effectively going to have a savings pot that's funded by your seed funding, right?
Yes.
But you're not making any additional contributions, right? So your savings pot is sort of limited to the seed funding. Is my understanding there correct?
Correct.
Okay, perfect. So let's do some quick fire questions, Renier. You've discussed this, but maybe just touch on it again. Can I access 1/3 of my investment value? Just very quickly brush on that.
No, you can't. So it's a misconception in the under members. The 1/3 refers to the contributions that you're going to make in the future to the savings pot. What you're going to have available on the 1st of September once seed funding is done, so the bonus allocation, if we want to call it that, on the 1st of September, is 10% of whatever is your fund value on the 31st of August. That'll be available as a once-off for the 2025 tax year. Going forward, 1/3 of your contributions made on a monthly basis will go into the savings pot.
Okay, and then will my withdrawal impact my marginal tax rate? And maybe when you discuss taxes, I talk about the difference in the tax rate, maybe just by way of an example, if possible, by withdrawing from the savings pot versus waiting until retirement, those 2 different scenarios.
Okay, so I'm going to try and do a scenario, and if I've remembered the last few digits of the, if I can't remember that, then excuse me, but I'm going to use the 31% tax bracket on your marginal tax rate as an example. So if you earn up to 370,000 Rand, that's if I remember the table correctly, you will pay 31% marginal tax rate on the value of your income in that little bracket. So say your salary is 360,000 Rand, so it's 10,000 Rand away from the bracket that you pay 31% tax in. And you now have 30,000 Rand available in your seed funding and you draw it. Remember we said drawing from your savings pot during active employment is taxed as income, meaning 360 plus 30 gives us 390. That pushes you into the new tax bracket, where you would then be paying a marginal tax rate of 35%, and that will and could lead to you paying more tax during the year than what you were supposed to pay based on just your cost to company income from your employer. So that's sort of the effect that it can have. And remember, if you've got different funds, each time you withdraw from this seed funding, so if you've got 5 funds and you've got 30,000 Rand available in all of them, you can add another 150,000 Rand onto your basic income cost to company, add that on, and that would be the new marginal tax rate. So each time you withdraw or you add, they look at your latest new marginal tax rate and they'll apply that. So that's during active work time when you make withdrawals from the savings pot.
Before you carry on, then need to jump to the next scenario. Just on that, before I forget, is there a possibility that a withdrawal from your savings pot could push you into a higher tax bracket? So in that year of tax assessment, you did, for argument's sake, the person is earning 360,000 and you drew whatever amount, and now it's pushing you into a higher tax bracket. Could that be possible?
That is very possible, yeah.
Okay, so that's a very important consideration.
It's also, I think they applied the marginal tax rate because it's going to affect people differently depending on the income brackets. But also, if you think about it, and that's why it's very important then when we talk to clients, when we talk to members, to make them aware that if you are going to be kicked over into a new bracket, your tax liability is going to increase, which is going to affect the net take-home pay that you have. All right? And also maybe cause you a headache when it comes to your annual return. Then in terms of if you're a diligent saver and you're like one of our colleagues in our office, he's like, I don't care about the 2-pot retirement fund is for retirement, and that's what my fund will do. I don't touch it until I retire. If you do not touch your savings during your active employment, when you get to retirement, that is the 1/3 or the lump sum commutation amount that you'll be able to take will be taxed at the lump sum withdrawal tables at retirement, meaning first 550, if you haven't used any bit of that in your past before, tax-free, then to 770, 18%, and then the sliding scale 26 and 36%, or 27 and 36%.
So there's a clear, like I said, a clear tax incentive for you to hold your retirement savings up until retirement. And I think that's the way the legislation is designed. It's quite punitive, actually, to take from your savings pot unless you really have to, right? Another question, Rainier, will my savings, and I think this is a very important question, will my savings pot be invested in cash? Because remember, your savings pot is now there for accessibility, right? So would members have an option to select different types of portfolios, one for your savings and one for retirement?
So in future, yes. Currently, if you invested in, say, a CPI plus 5 fund, your savings pot will be invested in the same portfolio. So the amount of development that has been done by administrators, they haven't gotten to that point yet where you can specifically the savings pot value invest that in a different portfolio. I think also when we chat to other trustees and when we chat to the trustees of our umbrella fund at 27.4, you know, the main consensus around the table when we talk about what do we do with a savings pot is that the trustees feel that your retirement fund is for the purpose of retirement. Retirement is not an event that happens within the next 12 to 18 months. It's a long-term investment of average 7 years plus, at the very least longer than that, but it could be as long as 30, 40 years. and that they take the stance that the investment in the retirement fund should be invested for the end goal, not for the short-term goal of maybe someone would want to withdraw from their pot once a year, or there's an emergency that is applied. So currently, the same investment strategy that you used to in your fund, that will be applied.
Okay, perfect. There's just a comment that comes through. So there's no cash drag on the cash portion. It will remain invested, basically.
Yes.
Okay, another question. So I think you've dealt with this, but just maybe reinforce. If you have more than one retirement savings vehicle, you're not only limited to one withdrawal, right?
No. So if you've got seven products, you can make a withdrawal from each of them. Each one of them will get seed funding, and on each one of them, they're going to ask you your tax rate or your income, so they can apply your marginal tax rate. SARS will then confirm, and then that will be paid out to you. So if you've got 7 products and you want to make a withdrawal from all of them with your seed funding, you can. You're not limited to its per product level. However, that could impact your tax that you pay on your normal income. And also it will have a dire effect really at the end of the day on how much you have available at retirement when it's most needed.
Okay, and then speaking about members over 55 and the decision to opt in, do they need to make that by the 1st of September?
No, they have 12 months from the enactment of the legislation. So 12 months from the 1st of September 2024 to elect to opt in to the two-pot system. We do encourage members over 55, on September they would be 58. We do encourage them to think long and hard before they do make the decision, because once you're in, you're in. There's no turning back and reversing everything. It's the same as when you go into retirement and you purchase an annuity with an insurer. Once you signed on the dotted line, there's no turning back.
Okay, and then given everything that we discussed now, Renier, right, we've got these 3 different components. And at the top of our discussion, we discussed sort of why the implementation of the two-pot system. Do you think this new system would result in that better retirement outcomes? Obviously, we don't know for sure, right? But the way the system is now designed, where you've got a retirement component that can only be used to purchase a living annuity or a guaranteed annuity, but effectively provide an income during your retirement. Do you think this new system would sort of result in better retirement outcome, in your opinion?
In my opinion, and from what I've seen and how I've had to help clients, understand that what they were expecting at retirement is not going to happen because they took money when they changed jobs. This is the positive part of, or for me, it's the best part of the two-part system, is the fact that we are forcing you to preserve your money to use at retirement. Nobody wants to go and stand in a queue for a day to get a 2,000 Rand grant, which is not going to take anyone very far, even in today's terms. So it's a positive change. I think the other positive change, when I put the economist hat on and I try and think about what they wanted to achieve, is that if I am allowed to withdraw money from my retirement fund when I am in dire straits and I have an emergency, and that's the only way I can think of taking care of that emergency, I don't have to resign with the possibility of not getting a job after I've accessed my funds. So we are keeping people employed by allowing them to have access by not having to resign to gain access to their retirement funds. I think from an economic point of view, we are a diminishing tax base. We have an ever-increasing unemployment rate in South Africa. We've had, there's been lots of talk around the job creations and where we need to find opportunities in South Africa. And I think with our new sort of GNU, there will be a lot of focus on that, and there will be a lot of focus in the agricultural sector, where it's easy to create jobs for masses in one bit. But unless we grow the tax base, we can't create more jobs. And if we don't create more jobs, then we're not going to go anywhere as a country. So I think from that point of view, this is spot on, sort of the best solution to make sure that you can access funds, but also for taking a burden away from the government to fund your retirement, but making sure that you can manage a lifestyle that you're used to.
So it's a positive thing, right?
It's a positive thing.
I think on that positive
It's a difficult thing to understand, but it's positive.
Yeah, so I think let's leave it there. I think it's a lot to digest, a lot to unpack. And I think we could probably talk for another hour on how the two-pot system could potentially impact retirement fund members going forward and the different scenarios and so on. But unfortunately, we have run out of time. Renee, thank you for joining me. I think we hope that we've provided some clarity around the new two-pot system. And I think just lastly from my side, I'll just mention that at 27.4, we obviously doing our part in terms of helping retirement funds and members transition to the new two-pot retirement system, whether it's trustee training to investment strategy, formulation and implementation, even risk management, even just reviewing fund rules. We've certainly done our part. And if you are on this call being a trustee, and you need some help, please do reach out to us, because we do have the in-house expertise to deal with that. I think from our side, please join us again for the next webinar. I think we're doing it sometime during December. And I'll be joined by our private markets team, and we're going to be talking about growth in the unlisted space and a few options that retail investors have to invest in private markets and private equity in particular. So from my side, goodbye, everyone, and I hope you have a good week ahead. Take care.
Take care, everyone.